Well, welcome to this explainer. Today, we're literally cracking open the ultimate survival guide for keeping any business alive. Whether you're bootstrapping a small side hustle or stepping up to manage a massive multinational corporation, the absolute bedrock of your success, it comes down to one single, undeniable thing: finance. Money is the engine, the fuel, and the foundation of all business activity. Okay, let's dive into this. Because right off the bat, I want to share a fact that genuinely shocks a lot of people when they first hear it. Many businesses fail, not because they have a terrible product, and honestly, not even because they aren't turning a profit on paper. No way. They fail simply because they run out of working capital. They literally just run out of the immediate hard cash needed to pay their daily bills. It's wild, right? So, here is our roadmap for today. First, the lifeblood of business. Second, capital versus revenue spending. Third, internal sources. Fourth, external sources. And finally, making the right choice. Let's kick things off with Section 1, the lifeblood of business. Just like a physical body needs blood circulating to function, a business needs finance, which we often call capital, to operate, to grow, and just to survive. And if money is the lifeblood, well, the finance department is the heart pumping it through the entire organization. Their role is incredibly dynamic. They aren't just sitting in some dusty back room counting beans. They're meticulously recording every single transaction, preparing the final accounts, like the income statement, and producing vital info for managers. Plus, they're constantly looking ahead, forecasting cash flows so the business never hits zero, and making those critical make-or-break financial decisions that steer the company's entire strategy. So, the crucial point here is understanding exactly what we mean by working capital. Basically, working capital is the money required to pay for day-to-day costs. We're talking worker wages, raw materials, the monthly rent, electricity bills, the daily grind. If you don't have working capital, the lights go out, literally and figuratively. Moving right along to Section 2, capital versus revenue spending. Now, a foundational rule of finance is that not all business spending is created equal, and categorizing it correctly changes absolutely everything. Here's the sharp contrast you definitely need to commit to memory. First up, capital expenditure. This is the big stuff, money spent on non-current or fixed assets that are going to last for more than 1 year. Think about buying a massive factory building, a whole fleet of delivery vans, or heavy machinery. Contrast that with revenue expenditure. These are your day-to-day running expenses that do not involve acquiring a long-term asset, so paying employee wages, covering the rent, or buying raw materials. One builds your capacity for the future, the other simply keeps you operating today. Make sense? All right, Section 3. Internal sources of finance, finding money from within. So where does the money for all this spending actually come from? Well, when you need cash, the absolute first place you should look is within your own business. It's generally the cheapest and safest route, though obviously the pool of cash is kinda limited. The first internal source is retained profit, basically profit kept in the business after dividends are paid. The huge advantage here, no interest and no repayment. But actually, new businesses don't have any yet, and hoarding too much might really upset your shareholders. Next, you could sell surplus assets, like maybe an old factory building you aren't using. It doesn't increase your debt, which is great, but it takes time to find a buyer, and the final payout is pretty uncertain. You could also sell off excess inventory. This smartly reduces storage costs, but you run the massive risk of running out of stock and totally disappointing your customers. Finally, there's owner's savings. This is cash that's quickly available with zero interest to pay, but it massively increases personal risk, especially for owners with unlimited liability who could literally lose their own homes if the business goes under. Yikes. Let's jump to Section 4, external sources of finance, looking outward for cash. But what happens when those internal funds just aren't cutting it? Or maybe you're a brand new startup with zero retained profits to dip into? Let's move to the next logical step and break down the pros and cons of traditional outside borrowing. First, issuing shares or equity. This is permanent capital that never has to be repaid. Awesome, right? However, shareholders are going to expect a cut of the profits, and original owners can actually end up losing control of their own company. Then we have your standard bank loans. They're quick to arrange, but they absolutely must be repaid with interest regardless of whether you make a profit or not. Need money for a really long time, say 25 years? Debentures are long-term loan certificates perfect for that. But again, that interest must be paid. Now, a fascinating option for quick cash is factoring debts. If customers owe you money, an agency will give you an immediate cash injection, say 90% of what you're owed up front, and then they collect the full amount from your customers later. You get cash instantly, but you don't receive 100% of your money. Lastly, grants. Government grants are amazing because they don't have to be repaid, but they almost always come with very strict strings attached, like being forced to set up your factory in a specific, maybe less ideal area. And we absolutely can't ignore the incredible modern alternatives out there today, especially for startups or high-risk ideas. Take microfinance, which provides very small loans to people in developing economies who are traditionally totally ignored by big banks. Look at the real-world story of Parveen Baji in Pakistan. She took a tiny $70 loan from the Cash Foundation to start a jewelry business. With just $70, she grew her enterprise, eventually running a super successful catering business that employs 8 people. She paid for her kids' high school and completely repaid her loan. It just proves these tools absolutely change lives. Another powerful modern tool is crowdfunding. Platforms like Kickstarter offer massive global reach and act as a totally free test of public reaction. But a quick warning, it's often an all-or-nothing gamble. If you don't hit your full target amount, every single penny usually has to be returned to the backers. Which brings us to the climax of our explainer, Section 5, making the right choice. With all these incredibly varied options on the table, how does an entrepreneur or finance manager actually decide which path to take? Well, it all starts with the golden rule of finance. You must always match the source of your money to the time frame you need it for. Never, ever use a short-term source to buy a long-term asset. For short-term options, needs under a year, you have bank overdrafts, which are super flexible because you only pay interest on what you overdraw, but the interest rates are pretty high. You also have trade credit, which is basically an interest-free loan achieved by simply delaying payments to your suppliers. For long-term options, needs over a year, you have hire purchase to buy an asset over time, leasing to use an asset without ever actually owning it, or a rights issue, which cleverly offers new shares to existing shareholders first so the original owners don't lose control. Now, what's really interesting here is a critical concept called gearing and the massive risk of relying too heavily on debt. Gearing basically measures the proportion of your capital that comes from long-term loans. Imagine a business with 55% long-term loans and 45% equity. Because more than half their capital is from loans, this firm is considered highly geared. This is a hugely risky position to be in. Why? Because loan interest has to be paid every single year, even if the business makes absolutely zero profit. A highly geared business can easily go bankrupt during just one slow year. Of course, getting that loan in the first place is a massive challenge in itself. Lenders don't just hand over cash blindly, right? To convince a bank to actually part with their money, an entrepreneur has to clear 4 exact hurdles. First, a cash flow forecast proving exactly how the money will be used and how it will be repaid. Second, an income statement proving the business is actually profitable. Third, collateral or security, meaning assets like a house that the bank can legally seize and sell if you default on the loan. And fourth, a meticulous, highly detailed business plan. Let's put everything we've just learned to the test with a practical scenario. We'll call this Paul's Dilemma. Paul is leaving his job to start a taxi business. He needs $20,000 to buy the physical taxi vehicle, plus he needs to pay for his fuel, his taxi license, and advertising for the first month. Now, a bank manager has offered him a loan, but his uncle is advising him to just use his own personal savings. I want you to think about this actively for a second. Based on what we've covered regarding timeframes and risk, what should Paul do? And this brilliantly illustrates how a finance manager would solve it. First, we have to separate his needs. Buying the taxi itself, that's startup capital. It's a capital expenditure for a long-term asset. The fuel and ads, that is working capital, revenue expenditure to keep the business running daily. The ideal recommendation here, Paul should absolutely use his personal savings to buy the taxi to completely dodge high bank interest and lower his startup risk. But if his savings are too low to cover the whole shebang, he should take the bank loan strictly for the taxi asset and fiercely guard whatever personal savings he has left to use as working capital. He desperately needs that cash buffer to ensure he can actually afford the daily fuel to drive the taxi. Which brings us right back to our central theme today. You can have the best product, a total genius service, or the shiniest new taxi on the block. But if you run out of cash for day-to-day operations, the journey is over. So I'll leave you with this final provocative thought to take away. If working capital is truly the lifeblood of a business, how closely are you monitoring the pulse of your cash flow? Thanks for joining us for this explainer. Keep learning, keep planning, and we'll catch you next time.